Good morning and welcome to this Wednesday, June 29th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it's been a while. First of all, last week we had some, technological issues at EarningsBeats and with Zoom trying to get our show going, and we ended up canceling last Wednesday, I think it was. And then Monday I was traveling, coming back from a family reunion, and the last two recordings over at Stock Charts have both been talking about market bottoms. So I haven't done one of these shows, I don't believe, since last Monday here and Tuesday, the recorded version at Stock Charts. So been a little while. Hope everybody's been doing well. We had a pretty nice rally there for, I don't know, maybe a week to 10 days. And yesterday things turned back down. We saw some deterioration in some of our sustainability ratios, and we're going to get into all of that in just a bit. But first, just wanted to welcome everybody. I'm going to go over and show you how you can follow along with us at EarningsBeats if you would like. If you go over to EarningsBeats.com, just go over to EarningsBeats, make sure plural, EarningsBeats.com, and then scroll down. We have a free EarningsBeats Digest newsletter. I always encourage everyone to come over and sign up. Name and email address is all it takes. No credit card required. You can unsubscribe at any time. It's a 3 times a week newsletter, very quick read, usually just a couple paragraphs and a chart. Just pointing out things that are important to us, whether it be earnings, gaps, relative strength. We might be looking at a particular industry group. Occasionally it has something to do with the S&P 500. You know, if we think it's going to, we're at a bottom or a top or whatever, and some of the reasons why. Try to make it very educational. There are obviously some trading opportunities along the way if you so choose, but that of course is completely up to you. Anyhow, I think it's a great way to get to know us a little bit here at EarningsBeats. Also, when we do free events, we reach out to everyone in our EarningsBeats Digest community, provide room instructions. So that way, if you're part of our community here, you won't miss that. So go over to EarningsBeats.com, scroll down, make sure you sign up for our free newsletter. Taking a look at the action from Tuesday, wasn't very good. Excuse me. We saw major indices basically close on the lows after, in the first, I don't know, maybe 5 minutes of the day, we were up, pretty nicely out of the chute. You can see the Dow, S&P, NASDAQ all above their 20-day moving averages. But by the close, we'd come back down and closed beneath. And when you're in a downtrending market with the 20-day below the 50-day and you break back down below the 20-day, it's generally not a very good thing. So I'm not here to sugarcoat it. It wasn't a very good day. Whether or not we continue lower and break to new lows remains to be seen. I've got some thoughts about that, which I'll talk about in just a few minutes. But overall, the day yesterday was not very good. And the other thing is, a lot of times when the market goes down, if it's a big gap down, we can talk a little bit about manipulation. There was no manipulating yesterday. I mean, we were up and then we sold off all day long. And that's never a good look. If you're a candlestick fan, or even if you're not a candlestick fan, I would say the worst candle that you can see is kind of what we saw yesterday, a big red filled candle that just reeks of distribution, a lot of selling. Now, is it profit taking? Is it a new round of selling, to the downside? Again, that remains to be seen. But the Dow did finish down almost 500 points, S&P 500 down 78.5. NASDAQ down 343. So on a relative basis, there was your loser. The NASDAQ down almost 3%. Mid caps down 33, small caps down almost 18. Both of those down close to 1.5%. Whoops, not sure what just happened there. Let's go back and try this again. I don't know what the heck just happened. Obviously, my fingers did something here. There we go. So looking at the sectors, you can see energy up 2.7%. Discretionary fell 4%. So energy, by the way, that was the only group that was positive yesterday. So this was kind of a return to what we've seen throughout much of 2022. Energy performing well, and that was it. Discretionary, technology, communication services, the three aggressive groups not performing well. Healthcare, throw that in there, another pretty rough day, down 1.75% on healthcare. But all of these groups you can see are all trending lower, except for energy. And even energy, you could maybe argue rolled over. I'd be watching a possible head and shoulder top on energy at this point, where you got your left shoulder come down to the neckline, then you go up for another, I don't know, 6 weeks, put in the head, come back down, test that neckline, and you look, we're actually slightly below that prior neckline or the prior low of the neckline. So this could be a final move up in energy to test the 20 and the 50. If we go back through the 20 and the 50, obviously you got better chance of bullish outcomes. If you can't get through and you go back down and break below 70, that would be the confirmation of a head and shoulder top breakdown. And that would measure, by the way, probably down to 55, maybe even $50 on the XLE. So I don't know if the energy run is over, but you know, we did a couple things here that we haven't done in a while. And number one was breaking below the 20 and the 50 by a considerable margin and going back to prior lows. I mean, if you go back, we've been going up, 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 been putting in higher lows. This was a change of character here, moving back down below the moving averages, testing that prior low, now trying to bounce back up and test the moving averages from underneath. Let's see what happens with energy. But discretionary, technology, communication services, all looking very weak still. One positive is on the recent low on the XLY, higher PPO. Technology, lower low, higher low on the PPO. XLC, lower low in price, higher low on PPO. So you got positive divergences across the board on the three major aggressive groups. Whether or not that plays out longer term, I mean, we did get up close to 50-day moving averages. I look for resets at the 50-day and at the center line, then kind of reevaluate or reassess based on what happens after that point. So we didn't quite get back up there. Maybe we will. Maybe yesterday was a head fake. I don't know. We're going to find out the rest of this week and into next week. We do have earnings coming up in about 3 weeks. And typically the market moves higher. Historically, I'm not giving you my opinion, that's a fact. Historically, the market moves higher heading into earnings season. Will that be the case this year? It doesn't happen every time, but there is a tendency, so we'll see. But again, healthcare failing at the 50-day, starting to roll back over again. We'll see whether or not we can get through the 50 and whether or not the 20-day moving average holds there. One thing I will point out, though, is I do like the fact that the AD lines remain pretty strong. And really, when you look at all of these charts, for the most part, with maybe one exception being communication services. But here, the Dow's going lower. Look at the lows on the AD line going higher. S&P down, lows on the AD line higher. NASDAQ down, lows on the AD line higher. Mid caps down, lows on the AD line higher. Same thing with small caps. Energy has been strong all year, starting to roll over a little bit. We'll see whether that continues. Discretionary, look at where we are versus where we were earlier in the year. We've got higher lows. Technology, higher lows. Communication services, finally a higher low. We had been going down in the AD line. So maybe communication services trying to turn a corner. Healthcare has been going up all year. Healthcare looks like it's being accumulated. So when I look at the AD lines, I don't really confirm the price action to the downside. And that's one reason. I would say it's a secondary reason, not a primary, but a secondary reason why I would be remain somewhat bullish at this point in time. All right, 10-year Treasury yield. So this morning we got the Q1 GDP out, the final GDP. And the estimate was minus 1.4%, actually came in at minus 1.6%. So that means 1 month from today, or close to 1 month from today, we will get Q2 GDP out, first reading. And it's possible we're going to see another negative GDP. And if we do, that's a recession, back-to-back quarters. I mean, I keep reading where people are saying, well, we might have a recession next year. I'm looking at the current data and I'm like, what's wrong with this year? Certainly looks like, I think it's going to be a mild one, but I wouldn't be surprised if we have a slightly negative GDP again next month. If we do, by definition, that's a recession, 2 quarters in a row of negative growth. Anyway, so GDP came in a little weaker than expected today. Not sure if that'll have any impact at this point, simply because, this is the third GDP reading of the first quarter. You have your initial, second estimate, and then the final. So this is old news. Okay, it's slightly worse than expected. I don't think the market at this point is worrying about what the exact GDP was in Q1. I think the market's looking ahead to not even Q2. I think the market's still thinking Q2 is not going to be that great. I think the stock market is looking out at least 3 to 6 months. And that's what is going to drive prices. That's what's going to drive the stock market. If we go lower and break to new lows and all of our sustainability ratios break down, that's telling us things are not looking very good. And my bottom call was not appropriate. If we go back down to new lows, but our ratios don't go to new lows, then I'm pretty much going to be in the same camp I am right now, believing that the market's carving out a bottom. And then the third possibility, I guess, is the market just turns back around and goes higher. And then clearly we've got a bottom and the market's liking what it sees down the road. So those are the 3 scenarios. No big surprise, up, down, or nowhere. That's pretty much all the time. But I think in this market right now, it's a little bit more important because things have been so weak and scary. Headlines, all the news, horrible. So trying to figure out which way it's going to go at this point in time might be a little bit more important than others when the market's just sailing along. All right, S&P 500. And by the way, that 10-year Treasury yield has, did peak back here at about 3.46%, and has been coming back down. We saw a couple of days back to the upside, but today it's a little lower. Let me give you the update there. Right now, we're down about 3 basis points, 3.17%. Do we hold on to this 20-day? Do we hold these recent lows? A breakdown back below 3%, I think, would be very, very bullish for equities, because we haven't lost, we've been in this uptrend for a while, with the exception there, maybe just a few days. We haven't really lost the 50-day moving average, tested it right there. So a definitive break back below 3%, I think, could give the bulls some ammunition to take prices higher. We'll see. All right, S&P 500. So I thought what I'd show here, I always like to talk about the S&P, but I was just looking, and this was a chart I showed members at EarningsBeats yesterday in my daily market report that goes out every day. But here you can see back on the 23rd of May, roughly the 23rd of May, we were at almost the exact same point on the S&P 500 that we are right now, right? Just a little bit above 3,800. And if you look at these ratios that I like to follow from where we were back on May 23rd to where we are now, you'll see that the QQQ is slight versus the S&P 500 has slightly outperformed. That's good. So even though the S&P has been flat, that means the NASDAQ actually has been a little bit better than that. NASDAQ houses a lot more growth-oriented stocks. So this is just giving us a little flavor of growth outperforming value for the better part of like 5 weeks now, maybe 6 weeks. XLY, XLP. Now this one, and this is a big one for me, it hasn't been particularly strong. I mean, it bounced pretty nicely back at the end of May, early June. But since then, you can see it's actually been rolling over while the QQQ versus Spider went back up and had a double top. So we're seeing a little bit of deterioration in discretionary stocks versus staples. So this is the one ratio that I'm looking at right now that, and it's a big one. I'll be honest, this is one I like to follow a lot. I don't want to see it break to new lows, especially breaking to new lows before the S&P 500 breaks to new lows. Now, if you're looking at this, just especially over the past few months, you can see that we just keep going lower and lower. And what we've seen in the QQQ SPY is we bottomed in May and we've turned up. We didn't go to a new low like we did on the S&P. Same with the XLY, XLP. Same with IWF, IWD, which is large cap growth versus value. Same with the large cap growth index. It's the Dow Jones US growth, large cap growth index versus Dow Jones US large cap value index. And you can see the bottoms were going up. And since May 23rd, going up. Mid cap growth versus value, bottoms going up. And then since May 23rd, it's been going up. Small cap growth versus small cap value, same configuration. Higher lows going up since May 23rd. Transports and utilities are kind of all over the place. I mean, overall, it's been going down like the other ratios, but you can see some pretty wild moves in both directions. They don't always go in the same direction. Transports versus utilities is growth stocks versus value. So you're getting a little bit more volatility. And this is one of the reasons why I don't show it as much, because I don't feel like it's as solid an indicator. I think over long haul, it does well, but short term, day to day, week to week, even month to month, I think you can see there are some pretty significant gyrations in this ratio. But even still, going back to May 23rd, transports have outperformed utilities. You wouldn't think that would be happening with the S&P 500 flat. And again, if you go from this low on May 23rd to this low in June, and then you come over here, you'll see that the transports utilities were going up. So more money is rotating into transportation stocks while the S&P 500 is going down. That doesn't make a lot of sense. When the S&P 500 is supposed to be one of the best leading indicators out there of our economy. So if it's going down, it ought to be telling us our economy's weakening. If our economy is weakening, you wouldn't think first of all, money would rotate to the defensive utilities, and you wouldn't want to be in transportation stocks if the economy is weakening. So what is this telling us? Well, it's a subtle little hint at a possible bottom. This is the way we've seen bottoms form in the past with these ratios moving up. So I talk about it a lot because I think it's really important. It's not just about what the S&P 500 is doing. It's not just about what some analyst at Goldman Sachs is saying. I get a lot of questions, by the way, from members saying, well, what do you think about this person's comments? Well, what do you think about, them thinking that this bear market's going on for 4 more quarters? I mean, I don't know what to say, except that's their opinion. I use the charts. I don't listen to anyone else. I don't follow anyone else. There are a few people, I'll read articles. I have respect because I think that they're pretty objective. John Murphy's always been one of those for me. If he sees the market going higher, he says it. If he thinks it's going lower, he says it. He doesn't try to sugarcoat. And a lot of the work I do, a lot of the intermarket work, really was inspired by John's work. I've just taken a lot of things he did and just started, researching and studying and trying to find ways to figure out the market better than everyone else. And sometimes it works, sometimes it doesn't. But we'll see how this plays out over the summer. I still believe the bottom is in. We'll see. All right. Equity only put call ratio. This is just the daily, move on the CPCE every day. And you can see it's pretty choppy. That's why I like to use moving averages to kind of smooth things out. I talked about the beginning of the year, we needed to reset sentiment. If I get rid of all this daily stuff, all you have to do is go in here under, instead of candlesticks or line chart, just go down here and put in invisible. That gets rid of all the noise. Now look at the moving averages. I'd say that we've been resetting since November. The 20 days been moving up. Here's the 50-day, which is even more, smooth because you're obviously taking much more data, 50-day moving average, but it's been rising. We're getting that reset we talked about at the beginning of the year. Sentiment was way too bullish. Everybody thought the market had to go higher in the equity or in the options world. That's a recipe for lower prices. It was just way too bullish. All right, let's keep moving on. So here's another chart of the S&P 500. Down below, I have the 5-day moving average of the put-call ratio. This does a pretty good job of catching tops and bottoms. I mean, if you look at the 5-day moving average, when it spikes and starts to roll over, that's when the market tends to bottom and move higher. Likewise, when we bottom and start to roll up, it's when the market tends to top and roll over. Let's see here. Now, you might say, okay, well, that means the market's going to keep going lower because we're starting to turn up again. Well, when you get into a bullish market, and I'm starting to argue a little bit more for a bullish market, when you see the S&P 500 make these big moves in a bull market, this 5-day moving average keeps going down. Here you can see it went down, rallied back up, and then started going back down again. So if we are moving to a bullish phase, it's possible we go down, we rally up for a bit, and then we start going back down. It's very possible. So again, I don't like that candle. If you see, it's very similar to what happened to us back at the beginning of June. Had a nice rally, had a little red candle, and then followed by these big red candles down. And you can see there's that little red candle. Then we start rolling back over, back below the 20, just like we did here. So anybody just looking at the S&P 500 may look at this and say, here we go again. We're going right back down to new lows. We'll see. I'm not ready to go there. I don't think that's going to be the case, but we'll see. Anything is possible, by the way. All right. The other thing I'll mention here is something I brought up back at Market Vision 2022 and something I talk about pretty frequently. This at the top is a 253-day, that's 1 year, moving average of the equity only put call ratio. This, you can see when we started to move up the beginning of the year, this is what I was talking about needing to reset. Look at where the 253-day moving average was back at the end of 2021. I mean, if you look back in history, it was way lower than it had ever been. And we had the S&P 500 go up close to 115 or 120% in 22 months, the largest 22-month move since I've been tracking prices back to 1950. That was the biggest 22-month move in history, at least over the last 72 years. We started to turn up just as the market topped. And I said back then, we were going to see this line, or at least I believed we were going to see this line go up. We were going to reset sentiment. Folks now are getting really bearish. A lot more puts being traded than calls. And that's how you establish the right sentiment to mark a bottom. And while the sentiment's been getting more and more bearish, of course, prices have been going lower and lower. Also back at Market Vision 2022 on January 8th, for those of you maybe who are listening to the show for the first time or weren't with us at Market Vision 2022, the low range that I gave was 3,500 to 3,800. That was when we were at 4,800, or maybe at Market Vision, we might've been 46 and change at that point. But I was talking about the top at the end of the year. 3,500 to 3,800 was my target to the downside. We got the 36. Pretty good, right in the middle of that range. Could we go lower? Sure. I mean, the market can do anything it wants. But like I showed you on those relative rotations, out of value and into growth, if you thought the market was going to keep going lower, if Wall Street believes it's going lower, why would the money start rotating to growth? These are some things that mark bottoms. I'm just pointing them out. I'm not guaranteeing you we're going to have a market bottom. I called it because I'm seeing it on the charts, just passing along what I'm seeing, and whether or not it works, I guess we'll find out. Couple of industry groups just to keep an eye on. One that I think is really important and is not performing well. I mean, if you said, hey, give me the bearish reasons, give me reasons why we're going to keep going lower, probably the first thing I'd point to is this chart right here, semiconductors. I mean, if I wanted to, you can always debate on either side of the stock market, environment, which way is it going to go? If you said, hey, I need bearish reasons, give me the bearish reasons why the market's going to go lower, I can always give you bearish reasons. I can always give you bullish reasons. That's why you get a lot of confirmation bias, where folks who believe the market's going lower, if they see anything that looks bearish, they say, see, that points to lower prices. And if you see anything bullish and you like to be bullish all the time, then you say, see, there it is. We're going to go higher. If I had to look at this and say, what is really bearish in my view, this would probably be the one near the top of my list, semiconductors. After topping back at the end of December, we have been going down. You see this double bottom right here at 6,400. We gapped below it, tested, failed. Came back to a new low, tested it again and failed. Now look where the 20-day moving average is. Look at that big red candle. Look at the volume start to increase. This is not a good looking chart. I'm not going to put this one in my ledger of reasons why I think the stock market bottomed. This doesn't fit that particular puzzle right now. So what I would love to see is semiconductors get back through about 6,400, 6,450. That to me would add another layer of bullishness underneath this market, but we don't have that right now. So AD line continues to put in higher lows. So there's a subtle bullish reason there to at least have hope. But look at relative strength. I mean, we just set a new 52-week low versus the S&P 500. Money continues to rotate out of semiconductors. That's not good. Now, we look at software, which is another important component within technology. Same thing. This one we had the high in November going lower. Here we had lower lows. Look at that. Pretty significant positive divergence there. AD line's been rising continually, even though prices keep going down. Look at the relative strength here. We actually bottomed in May. We got back up to about a 2.5-month relative high versus the S&P 500 on that recent move to the upside. But you can see we came back down quickly this week. We'll see whether or not, if we could turn around on software, get right back through the 50-day, given the relative strength that's beginning to show, given the AD line that's rising, I'd see that as a very bullish sign. But again, look at that big red candle back below the 20-day. Got some work to do. Final industry group that I'll show you is gambling. The gambling group, been going down for a long time. Positive divergence, higher lows on the PPO, lower lows in price. But what I really wanted to show you was this 15-year monthly chart. And if you go back, and let's throw out the pandemic low in March. If we go back the last 11 years, so more than a decade, 450 low there, 450 here, 450 here, here, right in there, 450 with the exception of that pandemic low. We just tested 450. This is a big, big support area for gambling stocks. And I'll just throw two of them up here real quick. Las Vegas Sands hit that 30 level. That was support back in 2015. We actually went down to 25 back in 2011, 2012. But I think that 30 level is something worth watching. And then Wynn Resorts. 2015 got down to about $50, maybe a little below. Same thing, pandemic low went below 40, but otherwise right around 50 low. This month here in June, Wynn hit a low of 50. So you can see 50, very, very important support. I'm not saying gambling stocks are going to take off from here, but if you're somebody who's trying to catch value in the market, I mean, this group is down near a major support level. I just wanted to point that out. All right. 3 you must see. Not really a whole lot going on with earnings at this point. So I'll just jump into the 3 you must see. We'll wrap this thing up. First, IBM. IBM, you can see, came back up with the market last week. 145 is very, very significant. And if we go back just the last decade on this daily chart, I mean, you can see right there, 145, 140, 136, 130 something, 135, 139, 139, 140, right around 145. I mean, we're trending up. IBM looks really good. I would really like to see that breakout over 145. Next up, not looking so good, Nike. Nike went through the 20-day yesterday after earnings, looked like, okay, here we go. Complete reversal, finished on the lows. Look at that volume, the heaviest in the last year. So Nike broke down below this prior low, really needs to get back up and hold through the 105 level, and maybe further down the road, let's get back through that 20-day. But Nike's got some work to do. Last one I wanted to show you is Boeing. Boeing, look at the failure yesterday. Got up to about 147 and change yesterday. Failed to get through the 50-day moving average on the close, though. Came back down. I mean, this, if you're going to short a stock, Boeing would be a great example of one to consider, just because you're at a major pivot or inflection point here, right around 140, 142. If we can't get through that, and especially if we break back down below the 20-day, Boeing could see a pretty significant drop here. Of course, if we break back up above 142 or so and close there, then I think Boeing would look much, much better. You can see that PPO trying to get through the center line. Also, the AD line. This probably isn't worth it. You don't want to ignore this. But we hit the highest AD point on this stock since probably back in August of last year. So it does look like the stock is being accumulated, even though it has had a rough 2022 so far. All right, that's all I had for today. Let's go back and take a quick look at the overall averages. Dow Jones up 27, S&P down 4, NASDAQ down 45. This is the one I'm watching the closest. We saw a lot of outperformance in the NASDAQ the past week to 10 days. It's okay to pull back for a few days, a little profit taking, but what we don't want to see is this accelerate to the downside and those prior lows on the S&P be taken out. So that's what we'll be watching for on the downside. In the meantime, a recovery with a move up all day today versus what we did yesterday, kind of a mirror image of yesterday, would be a very bullish sign. So we'll see whether or not we can get any of that today. All right, that's it for me. Appreciate you tuning in. I'll be back tomorrow over at Stock Charts TV at 9 a.m. It'll be a recorded show. I always do recorded shows there on Tuesdays and Thursdays, but I will be recording this one tonight based on today's action, and that'll be there tomorrow morning. So at 9 a.m., simply click on Stock Charts TV and you can listen to the next episode. Of course, the next episode here at EarningsBeats will be next Monday at 9 a.m. All right, everybody have a great day, and we'll see what happens as the day unfolds. Happy trading.